Good morning, traders. Today is the 4th of February. My name is Neville Hornsey, market analyst YouTrading, and today I'll be taking a look at technical analysis. Okay, before we get into the charts, we're going to look at sentiment. So for that, my first port of call is the Forex Heat Map on YouTrading.com. You see the bottom left-hand corner is red, top right-hand corner is green. So I'm seeing a risk off day today. That means we're moving out of the commodities and riskier pairs into the safe havens. And yeah, we should see equities sell off. Going into an equity chart, this is the S&P 500, but on active trader, it is the USA 500 CFD. Moving to the left, we've got the sentiment indicator on active trader. And we can see that 52% of traders are bullish, 48% are bearish. So for me, that's pretty much evens. Yeah, no real sort of sentiment direction there. So we're still working off the Forex Heat Map. If we go to a daily chart, what I look for is momentum to sort of continue in one direction, sort of pulling price action along. But price action needs to sort of confirm the actual trend. So what do I mean by price action? Well, for me, it's a swing low to a swing high, just happens to be all-time high. Then we're looking to see whether or not the next swing low is higher and the next swing high is higher. Obviously, we had a swing low here, 3-candle chart pattern. Then another 3-candle chart pattern straight away, signifying that once this low gets broken, this swing high is confirmed, and then we are now into a potential downtrend, or at least the start of one. Because this was the previous significant swing high, this is the previous significant swing low. Once that gets breached, then we're now into a downtrend. If we look at momentum, using the moving averages, the 200-period moving average kind of acted as support, but not really, because it was exactly what 200-point drop. So it's a bit of a follow through to the downside. We took out the swing low here from 30th of September 21 and also 18th of July 2021. So big move down, obviously took out some stops. Now what we want to see is some sort of relief rally, dead cat bounce, maybe. If this was actually all the bulls from 2020 getting out of their positions, what they need now is the latecomer buyers to come in. And then as they're buying, these guys can finish off their selling. So what do we look for next? Well, we look for some sort of confluence to see whether or not resistance is going to hold. So if this was previous support now acting as resistance, that didn't really hold. You can see that the 20 and the 50, the red and the green EMAs are above, and they did act as some sort of dynamic resistance here. If I go to an Andrews Pitchfork, now I said that this here was a swing high, this was a swing low, and then this was the next swing high. And then as this one got broken by the candle on the 20th of January, this was like an early warning that trend change was happening. So now we've got the 50 EMA on the daily chart and an Andrews Pitchfork upbound acting as some sort of confluence. So I'm just going to put a box around that. Then we've got the median line down here, and then a possible test of this swing low, and then obviously a test of this lower line. So if price was just to drop solidly in like one fell swoop, then we take out this swing low here and hit the lower bound of the Andrews Pitchfork there. All right, removing the Pitchfork. If I go to the Fibonacci retracement tool from the high to this swing low here, now we've got confluence of the third confluence. We've got the moving average, we've got the Pitchfork upper bound, and now we've got the 61.8 fib retracement. Obviously, lots of traders look at that as they do the 200-day moving average. And when 61.8 meets confluence with other dynamic resistance, then it becomes a self-fulfilling prophecy. So we've got that as well. So being a global macro fundamental analyst, you just sort of pick some, underlying market sort of economics data points. If they're trending lower, then the market's going to go lower. But trading is a lot harder. You need to pick your timings correctly. You need to mitigate your risk. So how would I recommend doing that? Okay, once we've got a swing high, we've got a 3 candle pattern here. The next day, you have to sort of anticipate being lower. So if we go to the 30-minute chart, now, obviously, this swing high here was the most sort of significant. And when price left it, it left a big red candle, this imbalance here. So when I talk about balance and imbalance, when you've got this sideways action where it sort of trades within the sort of mother candle, then that's a balance. Then this becomes an imbalance. And then we expect price to come back down, test the balance, and sort of do a wick test or a tail of a candle test. So if I just point out this one here, so this was an impulsive move away from this corrective move here. And you can see that price came down, tested it, and then tried to reject it. So we're looking for those sort of price actions to the downside now. So we're looking for a move away from a swing high, then a retest of a previous tail or wick. So obviously price is taking out this swing low here. Doesn't look like we're going to get out there today, but it's NFP day today. Who knows what happens in the sort of latter stages of today or next week. But what did happen today was this. So we had the overnight session. Amazon reported, just amazing earnings report, really. Then European session opens, which is this candle here, this red candle here. And then, this red candle here, this big red candle. So Europe opened, a bit of a sell-off. And then when it came to the London Open, this candle, all they did was run up, test the previous tail here, the low of this candle, found it to be resistance, and they sold off. So if you had been anticipating this swing high being a resistance, like we anticipate this one being resistance, you could have placed a sell limit order, and you could have placed your stop loss above the swing high. So that would look something like this. Sorry. And then you'd be targeting the next swing low, which would be something like that. Now, this is obviously an intraday chart. We could go back to the daily. And you can see we could have been in at the high. Now, I did say that if we were to go short, we could be testing the median line of the Andrews Pitchfork, or we could be testing even lower and going down to the lower bound. So whichever take profit you look for, it's going to be an asymmetrical trade, which is what you're looking for. You're looking to risk a little bit and win a lot. So assuming you just took out the swing low here, your risk to reward would have been almost 11, one risk for 11 rewards. So that's that trade done. Now we're just waiting to see what happens at the end of the London session and the US session. Will the traders use the liquidity that was down here, take it back up to test the 4,580 and this low here, or will there be a continuation to the downside? Now for that, we just actually seen it happen. Pretty much what I look for is when you get these sort of candles and then a displacement here, this impulsive move away, this imbalance away from the previous candle, then you just look to see if we can get a test of a previous low. If that low holds, then there's a continuation to the downside. You can just move your stop down. If that low doesn't hold, then you're just looking back through all of these candles to see which hasn't been tested. So you've got on the 30-minute chart, you've got the 200 period moving average and this candle's low. That one's been tested. And these are all been tested. So you could put your stop here at 4,505, or you could move it all the way down here in the hope that that initial test of this wick or tail, however you want to call it, holds, and then you get continuation to the downside. So that's how I look to trade, and that's how I look to use technical analysis. I hope that helps you today and in the future, and I'll speak to you again next week.